Hello, everyone, and welcome to our October investment market update. Apologies, we've had a bit of a hiatus on these over the last couple of months due to some technical difficulties, but we are now ready and back on track. Today, I'm delighted to be joined by Will Thompson, Chief Sustainable Officer and Portfolio Manager at Pacific Asset Management. Hello, Will.
Hi, Mike. How are you?
Good, thank you. Thanks for coming on today. Really appreciate your time. Now, obviously, we've had a bit of a conversation about the format of today's meeting, what we obviously do. You've already got your slides up. So over to you, really just give us a bit of an overview on what's been going on out there in the last 6 months, what we think is going to happen over the next few months. Obviously, quite a few pivotal things coming up, obviously quite pertinent with the elections, the most recent election in the UK, and obviously there's some trouble in the Middle East. So looking forward to getting your observations on what's going on out there.
Of course. Thank you very much. So I've got a few slides to run through. I'm going to start a little bit by talking about macroeconomics, inflation and central banks, and then just talk very, very briefly about sort of some of the elections, if we can sum that up in 5 or 10 minutes, which is always difficult. And then close just by talking a little bit about China and some of the news there we've been seeing about stimulus. So really, this is where we start a lot of our macro updates, because we think it's quite an informative way to think about what's been happening over the last 2 years. Markets really have been pricing 3 different scenarios. And, on the left-hand side, you'll see a lot of headlines about it. You'll see a lot of talk about it. That is the recession, where because of central bank interest rate hikes, we see a rise in unemployment. We see equity earnings fall. Typically it's a very bad market for risk assets. Consumer spending starts to drop as well. And there have been periods over the last 2 years where recession has looked likely, although we have not had one globally. On the right-hand side is the other end of the spectrum, where at times over the last couple of years, we've been pricing a no landing scenario. So despite those interest rate hikes, inflation is sticky. It continues through things like wage growth, employment remains strong. And really, this reminds us of the 2022 playbook. Obviously, we saw a very large spike in inflation. We saw equities and bonds falling together. We saw that correlation move positive. So tricky environment for multi-asset investors. And then finally, the third scenario really is that soft landing. So we get a normalization of inflation. Growth remains reasonable, so it doesn't fall into negative territory. It might slow, but it's not negative. And really, it's in this third of the sort of pricing where we see very strong returns for both equities and bonds. And in terms of where we've been, as mentioned, when we look back to 2023, I know that feels like a long time ago. At the start of 2023, we had no landing priced. People were very concerned about wage growth. They were very concerned about things like rents within the inflation numbers, and they were concerned that central banks hadn't done enough. Then we had a series of regional bank failures, and within a month, we immediately moved to price a recession. People were worried that monetary policy was too tight. And so, you can just show, this just really speaks to why there's been increased volatility in markets over the last 18 months. Where we are today, which I think is most informative, is that really I think we're in this soft landing camp, and markets are performing very strongly over the course of 2024. We have seen drops in headline inflation. I can come on to talk a little bit about that. We've seen growth remain remarkably resilient. And this, as mentioned, is a really positive environment for both equities and bonds, more so even for risk assets, so for equities. And that's one of the reasons why we've seen such strong returns from equity markets. We've seen continued positive earnings growth over the course of this year. And, looking forward, we think unless there's something within the unemployment data, we think it's probable that we'll continue to be pricing this soft landing. So, that sounds very easy. There's 3 scenarios. We've got to think about where we are, but it has been a very unusual cycle. So the post-COVID cycle has been very different to post the global financial crisis, for example. And really that's been because there's been a lot of fractures in various parts of the economy. So thinking about the US and the UK, we saw labor markets with extreme changes in demand. So, as we came out of the COVID experience, everyone shifted from buying lots of goods to wanting to buy services. They wanted to go to restaurants, hop on aeroplanes, go to hotels. And that shift caused a massive change in the labour market. I'll come on to talk a little bit more detail about, the fact that the labour market now looks softer than it did maybe 6 months ago. But the reality is, this unusual cycle has meant that maybe rate hikes haven't been as effective or haven't slowed the economy to the effect that they would have done in previous rate hiking cycles. Both companies and individuals have been very good at fixing rates at the low levels that they experienced in 2021. And that's one of the reasons why over the past 6 to 12 months, there have been lots of calls for recession, but we haven't actually seen one. So just on the inflation picture, very briefly, it's a little bit of a busy chart, but this just shows the US, Europe, and the UK in terms of their headline inflation, which is the pink, the yellow, and the sort of green line, and in terms of their services inflation. So as mentioned, that's things like hotels, it's airfares, it's rents as well, and sort of shelter. And we can see that actually the good news for central banks, the good news for economies around the world, is those headline inflation figures are pretty much back at central banks' targets of 2%. So that's very positive news. The one slight worry for them is that this services component of inflation remains pretty stubborn and reasonably high, between sort of 4 and 6% for these three major economies. And that's been a function of the fact that, as I mentioned, wage growth has been pretty strong. In fact, we've been experiencing wage growth of between 3, 4, 5, 6% over the past 12 months. And typically, as we know, when wages are growing, people tend to spend more on services. And the service sector economies, so again, going back to the example of restaurants and hotels, they're a lot more labor intensive. So that's one of the reasons why there's been stubborn services inflation. So you might say with that, why are central banks starting to cut? We've got a slightly stickier wage inflation picture. So what is causing central banks to about face and start to talk about cuts, and actually do cuts in larger size than anticipated over the past 3 months? And I think the clue really is in the employment market, so in unemployment. And this chart just very simply shows the total number of people that are unemployed in pink and job openings in orange. So how many jobs are available for people to apply for? And you can see that in 2022, there was a massive imbalance. There was very few people that were unemployed and many, many job openings. So the gap between the orange and the pink was very large. And that was part of this labor rebalancing or labor out of balance that we saw at that period. And then over the past 2 years, really labor markets have been coming back into equilibrium. So the number of job openings, this is for the US, but you could look across the world and you'd see a similar effect. The number of job openings is falling, and the number of people in total that are out of work is increasing.
So Will, that's quite a stark drop there, isn't it? If you look at from where it was just post-COVID, and the number of job openings that were there, and how that's significantly reduced over the last 2 years. Is that down to businesses thinking more carefully about employing more people, or is it a symptom to show that, because kind of getting conflicting views here, there's still growth, but we're seeing the number of job openings slowing down, and unemployment going up a little bit. So is there a bit of rationalization going on post? Because normally if you have a recession, that tends to be an opportunity for businesses to reassess their costs and workforce and things like that. So are we just seeing a bit of rationalization going on here, do you think, or is it more to it than that?
Yeah, I think the big thing that we're seeing in sort of labor markets is a sort of no hire, no fire type of market all of a sudden. So businesses struggled so much to fill those job openings in 22 and into 2023. And once they filled them, actually what they're not wanting to do yet, because they're still earning good corporate profits, they're not wanting to start to fire people. So businesses are holding on to that labor that took them a while to get. And then from the side of the employees, we can see from a metric called the quits rate, very few people are wanting to quit their job. So we have this sort of, exactly as you described, this careful balance between the fact that, you know, employers have gone through this very difficult period. They filled the gaps that they required, that were required of them. And all of a sudden, people are very unwilling to quit their jobs. So it's a pretty fragile period. It's a pretty finely balanced period, rather, in the sort of labour market, I would say.
Okay, so but your view is that that is what's going to be pushing interest rates to potentially come down a little bit. Obviously, we saw that and I think you've got a slide later on about this, is you know, interest rates should be coming down, but obviously the Bank of England last week decided to hold rates. And that's mainly down to what you've been discussing here, which is service inflation still being sticky and actually seeing a little bit of an uptick. That I guess they're holding on to those rates a little bit longer.
That's exactly right. So, I mean, particularly for the Bank of England, the UK had a very acute inflation problem, and a lot of it was very at the forefront of individuals' minds because it was focused in areas like food. They are striking a fine balance between the knowledge that they want to make sure the labour market doesn't soften any further, and also the knowledge that they've got some structurally higher inflation embedded within the system. It's really interesting, you know, as you said, the Bank of England on hold. But just this morning, an Andrew Bailey interview with The Guardian, he said that the central bank needs to be a bit more aggressive on rate cuts. So in terms of communication, you can tell how finely balanced this is. And I think it is, you know, sort of walking that tightrope between inflationary forces and a slightly softening labour market. So another way we can look at this, again, this is US focused, but the tale is true across the UK and across Europe, is using payrolls, which is obviously just the number of new people entering the job market. And what we show is the monthly figure in pink and the 3-month moving average. So sort of slightly longer term average in the purple line. And you can just see that the level of job creation, again, the level of people entering the workforce on a monthly basis has slowed. And this has become a very important metric for the market. You know, 12 months ago, everyone was waiting for the next CPI print and markets would move a lot off the back of it. Now it's much more about the US jobs report because we know how influential this is going to be to the Federal Reserve, to the Bank of England. But just to close this out on the labour market, there is some slightly good news. So when we take a forward-looking basis on some of the concerns around wage growth, around services inflation, we do see that it looks like there's a chance that wage growth is going to continue to decline. So what we see is that, you know, the ratio between those job openings and unemployment that I showed earlier, so the difference between those two, it tends to be a leading indicator of where wage growth is going. And that's just what the top line charts. So in orange, we have overall wage growth in the US, which is running, as I say, at about 4.7%. And then we have that ratio of how many openings there are in the market to how many people there are quitting their jobs. And then, you know, also another way to measure this is just in the bottom where we look at job openings to unemployed and how many people are switching their jobs. But I think the main point to take away from this is that, you know, the Fed, other central banks may well be looking at metrics like this and saying that, yes, we have wage growth, yes, we have services inflation embedded within the system, but really we need to look through that as the labour market softens. So just very quickly, I think it's worth analysing what the central banks are saying. You know, central banks have been incredibly important to markets over the last 2 to 3 years. So we think it's really important to listen to what they're telling us, particularly in an era of forward guidance. So Bailey, as I mentioned, you know, this slide is now out of date as of this morning, but he commented that, you know, we're on a gradual path down, interest rates are going to come down, and he's optimistic. So the idea really is that they're setting us up to let us know that rates are coming down. And the same is true in the US. So obviously going into the last Federal Reserve meeting, there was lots of debate around 25 versus 50. But prior to this, Powell had been saying that the direction of travel is clear. It's time for policy to adjust. And, ultimately it's our responsibility to move as fast or slow as they think appropriate. Powell's a very big consensus builder within the Federal Reserve. And so it's really important to listen to his public messaging, and it can kind of give us a view of where they're going in terms of rates. Just in terms of the pricing, I'll start with the US, but I can talk about the UK as well. So a slightly busy chart, but this really just shows interest rates in black, and then in pink, we have that 50 basis point cut that we had at the most recent Federal Reserve meeting. And the lines just show us how market pricing, so what the market expects for interest rates, has evolved from July in sort of purple, then to August in green, and finally to where we are today in blue. So really what the market expects is that we have a series of cuts rather, 70 basis points more cuts into the year end. So that in the last two meetings for the Fed would be a 50 basis point cut and a 25 basis point cut, and then a total of 7 cuts over the course of this interest rate cutting cycle. And for the UK, there's 25 basis points priced at the next meeting. There's now a 65% chance of 25 more basis points cut in December, with 5 cuts total. The reason I go through that in detail is typically in other examples of soft landings, so 1994 is a good example, and what we didn't see was the level of cuts. We didn't see 7 to 8 cuts at this depth during those soft landings. So the market here again is struggling slightly to price whether we're having a slowdown on the one hand, which will cause a deep cutting cycle, or whether we're having this soft landing where it's likely that we wouldn't achieve the level of cuts that are currently priced into the market. So, for us, while there is evidence of economic softening, we still think that soft landing remains the base case. And therefore, just from the perspective of interest rate cuts, it looks a little bit aggressive that we get 7 cuts out to sort of the end of 2025 for the US and sort of 5 or 6 for the UK. So, there's a lot priced into bond markets at this point in time.
I was going to say what we've seen though is that can change, because obviously we were expecting cuts to be earlier in the year on the US around April time, and it's taken till September. And it all comes back, doesn't it, to the sticky friend inflation, whether you see it as a friend or not, and what happens over, I guess, these next couple of months with energy prices, amongst other things. So it's interesting to see that Andrew Bailey and the US as well, the Federal Reserve, are talking about bigger cuts. But I'll be honest, my skepticism suggests we might not get those cuts by Christmas, because I do wonder whether they're going to use this as an opportunity to try and get down that service inflation, especially if they think jobs versus unemployment is relatively stable, I guess. So I think it'd be interesting to see.
Yeah, and I think, as I said earlier, we do live in a world of forward guidance, which should give the market some look ahead on where central bank policy is going to go. But of course, we also live in a world where central banks can say they're data dependent, which again slightly moves those goalposts, because data, as you said, in sort of February, March of this year came in a little bit hotter than expected in inflationary terms. And that just served to push back those rate cuts pretty dramatically towards the end of this year. So yeah, I mean, as I say, all remains to be seen, and some of those pricing markets are moving around reasonably rapidly. But I think just this chart again just really re-highlights the same thing. So it goes back to around 1995. It just shows the global CPI inflation in black. So another measure of inflation across the world. We obviously saw an enormous spike in 2021, 2022. So unparalleled back to around 1995, and that caused the pink line, which is across the world. We saw many central banks hiking in unison, and so that is the sort of number of central banks hiking in 22 and 23. And then in green, what we see is the number of central banks cutting. So in 2022, it's close to 0 in terms of how many central banks were cutting. Now it's much closer to around 50% of major central banks are cutting rates, which is positive. So we've seen ECB cuts, We've seen Bank of England and the Fed, obviously. The only area really where we're seeing hikes is in Japan. But for much of the rest of the world, including many of the emerging markets that were ahead of the curve in terms of battling inflation, we're seeing cuts. And typically, without a recession, that's a supportive environment for risk assets. So hopefully that covers off some of the macro. I mean, just in summary, I would say economic growth still looks reasonable. We look at measures of consumer sentiment, retail spending, all of those kind of measures of activity within major economies. They look pretty reasonable. The other thing that's different about this cycle, which I haven't mentioned here, but we could do a whole nother hour on it, is the amount of fiscal stimulus that's been pumped into economies over the last 18 months. Has meant that the growth environment has been pretty strong. Central banks are looking to cut rates. All other conversations we've had so far aside, for us, as long as we avoid that recession and we avoid a sharp spike in unemployment, we think that's a pretty reasonable outlook for risk assets for now. The major thing I think over the next 6 months to unpick is we have seen a rise in unemployment. In the US, it's gone from the low of 3.4%, which is absolutely full employment, if not more, to around 4.2%. So for us, it's continuing to watch labour market data in the short term, which will dictate, I think, in part, how quickly these central banks move. And also it will dictate how other asset classes move. So if we see a sharp weakening in labour market data, that would be much tougher for the equity market in the short term. I think that if we saw a continued slow, normal gradualization that we've probably seen over the last 6 months, I think. So just turning to elections, I mean, they say sort of try to avoid talking about politics in macroeconomic circles, but I think it's pretty hard to avoid talking about politics at this stage. We're right at the business end of the US election. Everyone's been following every twist and turn. It's been pretty incredible, I think, is the first thing we'd obviously all say, to have both a candidate or an incumbent withdraw from the race after a debate performance, to have multiple assassination attempts on a runner for president. I mean, we've obviously seen, we all know this, polarization, post-truth, all of those sort of things are forming a key part of this election campaign. And, I think there are enormous gulfs between both the candidates. Clearly, China is a key issue. I mean, some of the talk around Trump's tariffs on China are dramatic and, may well be inflationary. There's obviously geopolitical impacts with a Trump election in terms of the Russia-Ukraine war. But I think one thing that they have commonality with is fiscal policy. So they may well do it through a different means, but we've seen in the past how attracted Trump is to corporate tax cuts, which is another thing he's been talking about. Good for equity earnings, but can be inflationary in terms of broad-based tax cuts and can call into question clearly the fiscal deficit of the US. And we've also seen how attracted the Democratic Party and Biden and Harris have been to fiscal stimulus through spending, particularly when we look at things like the CHIPS Act, the Inflation Reduction Act. All of these have been pretty potent growth engines, but also in a way probably contributing to the inflation that we've seen over the last few years. So we know that both candidates have sort of, the Pandora's box of fiscal stimulus has been opened. And so for us, it's pretty important to watch how the election unfolds. In terms of having a strong view and giving you a huge insight into who's going to win, I'm afraid I can't do that. The one thing to take away, I mean, this chart is just from Predictit, so prediction markets. You can see how volatile really the difference at the start between Trump here, who's in orange, and Biden in pink was. Clearly after the assassination attempt, Trump's favorability rose pretty dramatically, as well as after that first debate. But at the moment, it's roughly 50-50. In this example, Harris takes a small lead in green versus Trump in orange. But the reality is, when you look at poll of polls, Nate Silver's work, some of the prediction markets, it's extremely close. And so clearly it's going to come down to a few swing states, and it's going to be pretty close. I mean, I think the only other insight really to add on sort of elections is, they often cause short-term volatility, but markets like certainty once they find out the winner. So, when Trump was elected in 2016, we saw a pretty sharp one-day fall in markets. And then once markets had figured out that Trump was going to be cutting corporate tax rates, they rallied pretty dramatically after that and continued to rally for a number of months. They're pretty emotionless, and they don't really take favorites in terms of who wins the political race. And of course, the other thing, oh, sorry, Mike, go ahead.
No, I was just going to say, I think it's a really interesting point that, people are understandably concerned around who's going to be leading the US, who obviously produce a significant proportion of the world's GDP. But as you just highlighted, when he was elected last time, there was an incredible growth within the markets. And I guess if we look at where we are with the Democrats right now, well, they're effectively a known quantity based on Kamala Harris being involved with Joe Biden to some degree. And I guess the markets will carry on doing what the markets do, regardless, I think, of who is elected. It's probably, and this obviously isn't for today, but it's probably more about their foreign policy and what might go on there that could be more interesting as to whether that impacts the markets in those ways. But I'm sort of fairly hopeful that if we're starting to see stimulus coming back from the Fed by dropping rates, that gives confidence back in the companies to start growth again. And that will just push on from where we are today. But it's important. And as you say, it will cause volatility. But I do sort of feel that the markets will do what the markets do, regardless of who's in. But having certainty over the next 4 years is really the important point for them.
I think that's exactly right. And, obviously, again, it's also about who controls the Senate and Congress. And again, that's close to call. And we know that when there's split powers amongst the different parts of the US system, that's actually typically beneficial for markets. Some of the most powerful returns are when either a Republican or Democrat is president and the other party is in Congress or the Senate. So
technically blocked, aren't they? There's very little that they can sort of dramatically change if they don't control both houses. So yeah,
that's
really interesting.
That's exactly right. And I think your point also, just to bring it back to the UK very briefly, maybe it extends to the UK. I mean, headlines around UK politics have been pretty awful for the last 2 or 3 years, and they probably haven't continued in the last 2 months, unfortunately. But I think our sort of view on UK politics is maybe to step away from some of the short-term noise, which is easier said than done, and really think that the UK has a series of undervalued assets now over the course of a few years, particularly post-Brexit. So lots of UK assets, maybe in the real economy, in property, or in the stock market, are very cheap. And so I think the one thing that the UK really needs is a period of stability. And maybe it's not incredible economic performance, but it's normalized stability and predictability that will allow people like US private equity or other asset owners or pension funds or someone to start to purchase these cheap assets. In some of the property vehicles that we track in investment trust space, they're being bought out by large private equity firms because in the UK they trade at a discount to the US. So for bargain hunters, it's an interesting market. So without
well
going
established,
into,
isn't it? It's a well-established market. It's just it's been out of favour for Brexit and other reasons of late. So, well, we've got a couple of minutes left. So I was really just going to see. I think your next slide takes us on to a little bit about China. So, can we just spend a little bit of time just going over where we are with China, and then we'll wrap things up for today?
100%. So I'll try and do this very briefly, and I apologise for a ton of text on a slide. I won't talk to it, but the reality is, as we all know, China's been facing pretty structural problems in its economy. So housing market's been dropping pretty rapidly as a result, essentially, of leverage. It's a bit like Japan in the 80s or the US in 2006, 2007. And the sort of residential real estate markets face a number of problems. For the stock market, there was also the issue that China decided to put in regulatory reform and regulatory crackdown at the same time. So we had a double hit, really: economic underperformance and markets being impacted by the Chinese Communist Party decision making. In the last few weeks and the last few months, we've been hearing much more positive noises out of the People's Bank of China, so the central bank, and also the government. So really, they've identified that this is a problem for them achieving their 5% growth target. And they've put in place a raft of different measures, including stimulating the economy from a monetary basis, signaling that they are going to start to spend a bit more money in terms of giving people handouts or stepping in to address the overhang of property that exists in many Chinese cities. So the reason we bring this up is it's good for global growth. China's a massive growth engine around the world. So when we think about that soft landing scenario, it's helpful that China maybe is putting into place policies that help it grow. But the other thing, bringing it back to a markets perspective, is for us, it's a really interesting investment opportunity. So, sort of start of this year, we were looking at technology companies in China, and we had noticed that the orange line, which is earnings for those companies, had dropped over 2022 pretty dramatically in 2021, but was starting to rise again. And sort of at the start of this year, China was uninvestable. It was hated. Everyone was saying, do not invest. And so for us, that's quite interesting. It was maximum pain. And so, for us, it's just, again, something to look at from a growth perspective, but also an investment perspective. So, what's happened to these Chinese tech companies over the last couple of months, or a couple of weeks, rather, it's been a very short period of time, is that they've rallied reasonably dramatically. It's worth saying they remain pretty cheap. They were 13 times earnings, so incredibly cheap, which is the pink line, versus the orange line. And they're up around 48% in the past 6 weeks. So it does show that, economies facing crisis, they do come under a lot of macro stresses. And sometimes the market reaction to even a small shift in sentiment can be pretty dramatic. Just stepping back to the macro economy, I think it does help it helps the US quite a lot that China's deciding maybe to stimulate and to help the sort of domestic consumer in China to sort of support global growth. So from a macro perspective, we think it's really interesting. From an investment perspective, we think, again, a pretty interesting area to be invested in.
That's great. Brilliant. Listen, Will, really appreciate your time today. I think that's been a really enlightening presentation. And it all feels reasonably positive, dare I say, for the usual caveats in things go up and down. But yeah, ultimately, it's been really enjoyable. Thank you very much for that oversight, and look forward to welcoming you again, hopefully in the future.
Thanks, Mike. Thanks very much.
Thanks.